Welcome to the discussion. Today we're diving into a fascinating paper that challenges conventional wisdom about stock valuation. It argues that future returns, not future earnings, are the primary driver of a company's price-to-earnings ratio.
That's right. The prevailing belief has long been that a company's projected earnings growth is the key factor in determining its stock valuation. This research suggests a significant shift in that perspective.
Intriguing. So are we saying that high growth, high multiple stocks are actually overvalued?
Not necessarily overvalued in the short term, but the long-term returns often don't justify those high multiples. The study found that high multiple stocks, often labeled growth stocks, don't consistently deliver the earnings growth needed to support their initial price.
This is quite a departure from the traditional view. Let's unpack this further. The paper's central finding is that future returns account for a significantly larger portion of the variation in valuation ratios than future earnings growth. Can you elaborate on that?
Absolutely. The research analyzed U.S. stocks from 1963 to 2020 and found that approximately 75% of the differences in valuation ratios are explained by differences in future returns, while only 25% is attributable to differences in future earnings growth. This suggests that returns are 3 times more influential than earnings growth in driving stock valuations.
That's a striking statistic. So investors are essentially overestimating the impact of future earnings growth?
It seems that way. The study suggests that the market may overreact to perceived growth potential, leading to inflated valuations that don't always pan out in the long run.
The paper explores two potential explanations for these high valuations: risk premia and mispricing. What did the research find?
The study found limited evidence to support the idea that high multiples are primarily driven by risk premia, the idea that investors are willing to pay more for stocks that hedge against specific risks. Instead, the models based on mispricing performed better in explaining the data.
So it's more likely that the market is simply mispricing these stocks?
The research suggests that's a more likely explanation. The high multiples don't always translate into the expected earnings growth, leading to a gradual decline in price over time.
The paper also challenges the common use of the term growth firm. How so?
Many firms with high multiples are labeled growth firms, implying rapid earnings growth. However, the study found that many of these firms don't actually grow significantly faster than their peers. This suggests that the growth label is often a misnomer, and the high valuations aren't always justified by substantial earnings growth.
So the market is essentially mistaking correlation for causation?
Precisely. High earnings and high multiples often go hand in hand, but that doesn't automatically mean the high multiple is justified by future earnings growth.
The paper acknowledges that investors can still achieve high returns on high multiple stocks, but only under specific circumstances. What are those?
Yes, if you buy a high multiple stock early in its upswing, before it reaches its peak, you can certainly make significant short-term gains. However, the study emphasizes that these gains often don't persist over the long term.
So the long-term picture is less rosy for high multiple stocks.
Exactly. Over longer periods, the multiples of most firms tend to converge, meaning that initial high valuations often correct themselves.
The research also examined the impact of market cycles on stock valuations. What did it reveal?
The study analyzed 10-year rolling periods and found that the performance of high multiple stocks varied significantly depending on the market environment. For example, buying high multiple stocks in the early 1990s, leading into the dot-com bubble, yielded strong returns, but buying them in 2000, at the peak of the bubble, resulted in significantly lower returns compared to low multiple stocks.
So market timing plays a crucial role in the success of high multiple stock investments.
Absolutely. The study highlights the cyclical nature of high multiple stock performance, emphasizing the importance of considering the broader market context.
This research seems to lend support to the value investing strategy. Can you comment on that?
Yes, the findings suggest that value stocks, which typically have lower multiples, tend to deliver higher returns over the long term. This is because their valuations are often less inflated, and their stable revenue streams provide a more reliable foundation for future returns.
So value stocks offer a more consistent and less risky investment approach?
Generally speaking, yes. While growth stocks can offer significant short-term gains, value stocks tend to provide more stable and predictable returns over the long run.
Interestingly, the authors stumbled on these findings somewhat unexpectedly. Can you tell us about that?
They were initially working on a different project when they decided to test the conventional wisdom about the relationship between multiples and future growth. They found that the traditional model didn't hold up, leading them to investigate further and ultimately uncover these surprising results.
It's a testament to the importance of questioning established assumptions. The paper clarifies rather than contradicts some previous research. How does it do that?
Previous studies correctly showed that high multiple firms tend to have higher earnings and profitability than their peers. However, this research highlights that they don't necessarily have higher growth in earnings or profitability. This distinction is crucial, as it explains why the high multiples may not be justified by future performance.
So it's not about the level of profitability, but the rate of growth.
Exactly. The high initial price needs to be justified by substantial future earnings growth, and that's not always the case.
What are the key takeaways for investors from this research?
For investors with a long-term horizon, the research supports a value investing approach favoring stocks with lower multiples. It also suggests a need for greater skepticism towards high multiple stocks, requiring a careful assessment of whether the projected earnings growth can justify the current price.
So investors should be more discerning in their assessment of growth stocks.
Absolutely. They should critically evaluate the projected growth rates and compare them to those of similar companies to determine if the high multiple is truly justified.
Does this mean that high multiple stocks are always a bad investment?
No, there will always be exceptions. Some individual firms may experience exceptionally rapid growth, justifying their high multiples. However, the research suggests that this is not the norm. Investors should be aware of the inherent risk involved in investing in high multiple stocks, as their long-term returns may not always meet expectations.
So a healthy dose of skepticism is warranted?
Definitely. Investors should carefully consider the potential risks and rewards before investing in high multiple stocks and ensure that their investment strategy aligns with their risk tolerance and investment horizon.
The paper seems to align with Warren Buffett's investment philosophy.
Indeed. The research supports Buffett's emphasis on value investing and the importance of considering long-term returns rather than solely focusing on short-term growth prospects.
A valuable reminder for investors of all levels. So, in essence, this research provides a compelling argument for a more nuanced approach to stock valuation, emphasizing the crucial role of future returns and the potential pitfalls of relying solely on projected earnings growth.
Precisely. It challenges long-held assumptions and offers valuable insights for investors seeking to make informed decisions. The research highlights the importance of a long-term perspective and a thorough assessment of both growth potential and risk.
This is a great discussion. Thank you for your insights.